Bank going to do? It is all set to announce the sixth bi-monthly policy on Tuesday, and the market seemed to have factored in a pause. The speech will be more important for the RBI's views on current liquidity tightness. The governor hints on what kind of a deficit he will stomach and cues for growth and inflation in the coming year. Now, CNBC TV 18's Ritu Singh has polled treasury heads and economists from across India's top banks and reports the markets will look for the RBI's cues on all of those issues, but of course is expecting a status quo policy for tomorrow.
Governor Rajan may pass tomorrow's monetary policy day without any action, said all the top economists and treasury heads polled by CNBC TV 18. He is most likely to say he will wait for the fiscal deficit numbers before he brings down rates. After all, just on Friday he spoke strongly on this issue.
Ordinarily, one would think that a government should borrow less, that is, run lower fiscal deficits in order to reduce its debt. But there is indeed a theoretical possibility that the growth generated by a fiscal expansion is so great, so large, so fantastic as to outweigh the additional debt that is taken on. Unfortunately, this depends on growth multipliers on government spending, which at this juncture, by most estimates, are likely to be relatively small. So more spending will probably hurt debt dynamics.
According to CNBC TV 18's poll, the key repo and cash reserve ratio rates will remain unchanged in this policy. However, an overwhelming 90% of the respondents said RBI will remain in an accommodative stance. While 60% expect only one 25 basis point rate cut in the entire calendar 2016, the remaining are divided between a 50 and 75 basis cut through the year. 60% expect the tone of the statement to be similar to the December policy, but 30% expect a slightly more dovish tone. On the macro indicators, the majority believes the GDP forecast for FY16 will be maintained at 7.4%. But it is Governor Rajan's comments on inflation that will be most closely watched. Half the respondents expect the retail inflation target for January 2017 to be maintained at 4.8%, but the other half expects it to be raised to 4.9 to 5.4% in this policy. The bigger problem the market faces is the tightening liquidity in the system. Is RBI sympathetic on liquidity and will it buy bonds? Is what the markets want to know. More importantly, what is the longer-term view on liquidity next year? 70% of our respondents said that would be more important than his remarks on rates. In Mumbai, Ritu Singh.
So that's a unanimous verdict a day ahead of the monetary policy. Now, it is going to be status quo. Here's the other big